October's a time of anxiety for investors. The month's been disproportionately disastrous, from the 1907 Knickerbocker crisis to the Great Crash of 1929, Black Monday in 1987, or the realisation in 2008 that the world financial system really was in deep trouble. This year we enter October with the markets in a more than usually febrile state. As one hedge fund manager put it, we're panicking and we don't even know why. Nervous investors won't be reassured by looking back at history. The sample size is of course too small to be statistically valid, but more than a quarter of all the monthly falls of a tenth or more over the past century and a half happened in October. I should say this is using average share prices over the month, as calculated by Professor Robert Schiller, rather than just the price at the end of the month compared with the previous month end. Now, there are lots of stories told about why this should be the case. Low levels of trading over the Northern Hemisphere summer often means that price swings are played down. When business resumes in September, investors may react badly to what's been going on as the senior fund managers return to the office. Indeed, September's been the next worst month after October. You can see that on here. Now, this might just be chance, of course. After all, October can be wonderful as well, as in 2011, when equities rebounded more than a tenth after the miserable late summer performance, even worse than the dismal quarter that we've just lived through. Now, there are other parallels to 2011 as well. Back then, investors were deeply fearful, crowded into defensive positions and worried about both the US following its near default and the renewed crisis in the Eurozone. At the moment, investors are scared and they're crowded into defensive assets, but they're worried about different things. The global impact that the problems in China and emerging markets will have in particular, but also whether or not the Fed will raise rates. Market measures of fear, such as the VIX gauge of implied volatility priced into US options, or the ratio of the purchasing of puts or call options, have been falling back from levels that were last seen in 2011. This chart shows one measure of fear, the gap between American investment newsletters classed as bullish and those classed as bearish. At the moment, the pessimists outnumber the optimists by the most since, yes, September 2011. The result is that the market's finally balanced, as we've seen in some of the extreme moves in things like Glencore shares. Big falls in the market can generate their own reality, as lower prices make it harder for companies to refinance and create financial problems, feeding downward momentum. We're already seeing hedge funds having to unwind a lot of trades, making some big losses. But if nothing awful emerges soon, the sense of panic should abate, and bounces like we're seeing in the markets today could make October a month to relish.